Hey guys, welcome to Market Uncharted. Today we have an important topic to discuss for you out there beginning and want to start investing. This is an important topic which is stock styles and stocks types because we as an investor need to understand what is out there in the market, what type of companies are out there and how can we take advantage in investing in them. So let's start. First, one of the stock styles is growth, these are companies that have a big potential for the future. They may not be profitable yet, but they are growing faster than the overall market. Increase in the stock price is the main way to make returns. And we have here as example Facebook, Netflix, we have stocks as Alibaba, several others. Amazon, a lot of companies out there that we can invest thinking about growth, and is one of the type of investments that we can diversify our portfolio. Then we have some value trades. These are trades that are here for a long time, that they are reliable and may be trading at a temporary discount to their peers or the market. Increasing the stock price or dividend payments is the main way to make a return. I bring to you Cisco and IBM, but again, there is others out there that I strongly encourage you to check it. And then we have another like income companies. These are companies that pay a good dividend and have a consistent record of doing so. Dividend payments are the main way to make a return. These are companies that are in the markets for so many years, some of them more than 50 years, and during that period of time, they consistently pay dividends to the shareholders. So if you are an investor kind of averse to risk, you can invest in these companies expecting a comeback, a return via dividends. Although the stability of the company allows you to receive dividends, you may not expect huge growth over the past few years because they already are established mega cap companies. Then we go to the stock types, and because within the family of stocks, there is the all stars and there is the dogs of the stocks, and this is important to make a small difference. So, a blue chip stock is a stock that has a large capitalization, is stable, and has excellent reputation. So, it can be Apple, Facebook, Alibaba, Amazon, Netflix, and so on and so forth. Then you have the growth stocks. These are stocks with rapidly growing earnings and revenues and increased market capitalization. And I can give you an example. We have last year IPO called Lemonade Inc., which is a insurtech in the business of insurance that had tremendous growth, tremendous earnings revenue, and all combined became a really growth stock. Then you have the dividend stock type, which is the companies that basically they pay the earnings to the shareholders, and all to the years they can become like a dividend aristocrat, such as AbbVie Inc. in the United States. This is a company that pay over 50 years dividends to the shareholders, that makes him a really huge company in this sector. Then you have the cyclical stocks, which these are stocks that are dependent on the economy's health. So which means that during the year or during periods of time that slow economy or high economy, that determines the way they behave. So let's put here a little comparison of cyclical versus non-cyclical stocks. So a cyclical stock needs to perform well in a good economy, is really volatile, is sensitive to economic changes, high volatility earnings per share, and usually is considered like a luxury because has high risk, higher reward. Then a non-cyclical stock is a stock that might perform in a slow economy as well, is really stable, has a low beta, and is considered as a necessity. So it's kind of like lower risk, lower reward. So you can have higher growth in one side, lower growth on the other, but dividends and stability on one side, volatility on the other. Then we have defensive stocks. And these are the type of stocks that offer service that people always need. It's a necessity. These are the type of stocks that, independent of the economy, you always going to need, like Johnson and Johnson, Procter and Gamble products, all of these type of companies that work very well because we, as humanity, we need these type of products and service they offer. Then you have penny stocks. These are stocks under $5 that are extremely volatile. Investors always search for these in hopes for the next NIO or Tesla because they expect such a lower stock might one day grow to the levels of Tesla of $800. Therefore, although the penny stocks are really volatile, really risky because much of these companies have lower employees, small products and services to offer to the society, so they don't produce a lot of revenue, but it's the investors that look for risk look at this type of companies in hopes that one day these companies perform very well. And now, ladies and gentlemen, just a small bonus before we finish. These are the type of investors that make mistakes when they start trading. And let's just go one by one really quickly. Only buying hype stocks, for example, Tesla, when they are already at all-time highs, is when you start buying this share, which is wrong. Although Tesla is an amazing company, he has, during the period of time of trading, points to buy and points to sell. And in a whole time high, I can never advise you to buy some stock. Sell on the first drop, and this is because we get stressed about the share going really down on a panic moment, and we immediately sell, and the next day it just comes back. Not reading investing books because we go straight through to investing without see the basics first. Buying based on the dividend yields, which means they want immediately return. They don't see why the stock may be down, what are the environment that the stock is facing, what is their competition. Then copying YouTuber stock picks, and this goes to Instagram, Telegram, all of those groups that give you the trades. You just copy past without doing your own research. Failing to diversify because people think diversify is buying stocks on different sectors, and is nothing to do with that. We need to see all of the asset class that we can invest in. Thinking that everything that we see as a price earnings ratio low, it's immediately buy, which is not the case. Always trying to beat the market, and again, we need to be humble in order to take the losses, cut it, and then let our profits flow. Trying to time the market, always trying to find the bottom, always trying to find the maximum. Mistaking trading with investing, because if you trade every day, you are doomed to lose money. It's simple as that. Picking the wrong broker, paying too much commissions, or paying commissions to a counterparty that has a really high risk of defaulting. Overcomplicating investing, which means trying to compute strategies that are too much. Not accounting for fees, because this is also a fault of many brokers that say to investors that they don't charge fees, which is completely false. Anyway, people need to investigate, do their own research. Only buying tech stocks, this comes a little bit with failing to diversify, because buying tech stocks, you are only focusing in one sector only. Investing by margin, this is the leverage risk, right? We try to gain so much money with leverage that we can lose at all. And trust financial news, and this I can give you an example. 2 days ago, 3 days ago, when I saw the news of CNN that Bitcoin was in a bear market because it was down 2 days, and 2 days after was at the same level. These are the type of information that don't trust this financial news. They don't know what they are talking about. Alright guys, thank you so much for watching. Don't forget, knowledge is not power, knowledge is potential power, execution is everything. So do your own due diligence, do your own research before investing. Don't trust anyone but yourself. And I hope to see you guys on the next video. Thank you so much. Please subscribe our channel, and don't forget, just like the markets, we will not rest.